Tell me something. What do Amazon, AMC Theaters, Meta, Ford, Google or Alphabet, Costco, Coca-Cola, Berkshire Hathaway, Apple, Walmart, Netflix, Shopify, Disney, Johnson & Johnson, Robinhood, AMD, Palantir, Starbucks, Tesla, Target, Nvidia, Neo, Intel, GameStop, and Microsoft all have in common? They are 25 of the most popular stocks in 2026. And what we're going to do today is take all of them and rank them from the riskiest stocks to own over the next 10 years to the safest stocks to own over the next 10 years. Now, that 10-year time horizon is important. I'm imagining that you buy today and hold it until 10 years from now. And when I make those decisions, I'm going to be using three big things. One, how wide is the company's moat or its defense? Two, what kind of optionality or offense or ability to increase new revenue streams? How high is that? And third, what are you paying for it today? I look at the valuation. Now, it's important to note that there's no way that I'm going to get all of these right in order over the next 10 years. But it's more about introducing mental models, the framework for how I'm doing this, because there's four buckets that these stocks ended up in. The first bucket is the riskiest. These are the stocks that I think have the least likelihood for outperforming the stock market over the next 10 years and also have a minuscule, in my opinion, opportunity for massive outperformance. They are downside skewed. The second is very interesting. This is the bucket where the best performers will probably come from and also some of the worst performers. Wide variance bucket, where these companies over the next 10 years could go boom or could go bust. The third is kind of your more boring category. It's the ho-hum stocks, where I believe that this bucket of stocks will largely mimic what the market writ large does over the next 10 years. They're basically an index proxy, tightly matching the market. And the fourth bucket is the safest stocks, where I think they won't be the best single performers out of these 25, but as a group, I think they'll have the highest percentage that outperform the market over the next 10 years. So with that being said, let's dive in, starting with tier number 4, the riskiest stocks that are heavily tilted downwards in terms of their potential outcomes and unlikely to beat the market, in my opinion. It should be no surprise what comes in at number 25 and number 24, because they are largely meme stocks, starting with AMC Theaters. There really isn't much of an economic moat around these theaters, even though movies are making something of a comeback. The overall industry has been in decline and disrupted over the last 10 years. The optionality that the company might have is really burdened by a balance sheet that restricts what they can do, and I think that the valuation is expensive. Right next to them, coming in at number 24, is GameStop. That shouldn't be too much of a surprise. Now, like AMC, their industry has been disrupted over the last 10 to 15 years. They are making pivots into what's popular today, and it is worth noting that they have lots of cash to make a pivot, but my faith in their ability to do that pivot and still have it be around and be meaningful by 2036 is very low, and I think that the valuation is quite expensive. Now let's get into some non-meme stocks. We'll start with number 23, which is Target, a stock that I actually looked at recently, but when I think over the next 10 years, my opinion is this economic moat is under attack, both from Walmart and Amazon. And I realize that they've kind of carved out a space in between those two. But when we think about optionality, I don't think that there's that much room to expand their store footprint. It's really just about refreshing their stores. The valuation today, after a nice run up, I think is reasonable. So it comes in ahead of those meme stocks, but those first two really dampen my outlook about holding this stock blindly for the next 10 years. Coming in at number 22 is Neo, Chinese electric car maker. Look, the moat problem here is that BYD is absolutely dominant in Asia. And I know many Americans aren't familiar with BYD because we don't have them here, but I live abroad during the winter and I've seen these cars. They're impressive and they're really taking market share. Now, there is some optionality baked into Neo, a battery as a service project, some technology products. But the bottom line is that it is very difficult industry dynamics. The valuation is reasonable. And lots of American investors, for good reason, have shied away from investing in almost any type of Chinese stock because of how things can change very quickly based on government edicts. NIO is joined by a fellow car company of the top 25 most popular, which is Ford. So look, Ford and NIO are both largely cyclical companies, and you don't want to think as much about holding a company for 10 years blindly if it's largely cyclical and highly commoditized, and that's what Ford's industry is. Now, initiatives like Ford Pro for fleet management, those could be meaningful optionality, but it faces the same pressure that everything else does. There was a point in time where EVs were going to save Ford, and now we see that demand for that is down. It is cyclical. That said, the valuation is reasonable today, but it's all about when you get in and when you get out, especially in cyclical industries, which is why Ford comes in at number 21. Coming in at number 20 might be a surprise here. It is Starbucks, stock that I've owned in the past. Now look, Starbucks definitely does have a brand. You can be traveling anywhere in the world, and if you want to know what you're going to get, for a cup of coffee, you go to a Starbucks. That said, what else made it important and impressive in its growth in the past was creating a third space where people could gather. And it has largely abandoned that in favor of their drive-thrus. And look, I think those drive-thrus matter, but they're also much easier to replicate. I also am not sure how much optionality is left for this company. There's a lot of saturation. A lot of growth is dependent upon China, where there's a lot of homegrown competition that they have to go up against. And I think that this stock is expensive today. So believe it or not, Starbucks ends up in my riskiest bucket. And one of the reasons is because I don't think most people think of Starbucks as risky, which actually makes owning it over the next 10 years, in my opinion, risky. All right, now let's get into tier 3. This is where there's going to be the most variance. The biggest winners over the next 10 years amongst these 25 top popular stocks will probably come from this bucket. But so will some of the worst performers, because there's multi-bagger potential and catastrophic downside potential. Let's start with number 19, which is Intel. Intel has had new life breathed into it. Why? Because AI is so important. And as AI grows in importance, the people that make the chips, the things, the GPUs, the CPUs, the things that we need to make these technologies run are largely manufactured on a tiny island just outside of China by Taiwan Semi. And our reliance on that is problematic for the US government. And so its big intangible moat that it has right now is it's really the only player in the United States that can manufacture these incredibly valuable chips. And so the optionality then becomes that it becomes too big to fail for the United States society and government. That being said, a whole lot of the optimism around that has been baked in already, as the stock has absolutely exploded. So that's why of this group, it lands at number 19. Coming in next at number 18 is another company in the space, which is AMD, one of the 25 most popular stocks this year. Now, AMD makes chips that compete with the likes of NVIDIA. It does have a narrow but a widening moat in CPUs, and it could really be a long-term winner, especially as it offers an alternative to NVIDIA. But I will say that based on the numbers, this is one of the more expensive stocks and a stock that has had limited opportunity to really prove its moat when it's not like what I call selling water in a desert, where people need chips right now more than anything, and they're willing to pay big prices for it. That benefits everyone in the industry. But the big question is what's going to happen when supply and demand come into alignment? That remains to be seen. Coming in at number 17 is one of the greatest battleground stocks of the past decade, which is Tesla. In my opinion, when you look at where the company makes its money, primarily automobiles, some in electricity generation and storage, that automobile business especially has seen its moat shrinking. The low-cost production, the brand value, it has less value than I thought it did just a few years ago. Now, the reason that the stock has stayed afloat is because of the optionality. Full self-driving, energy generation and storage, robotics, a potential merger with SpaceX. We don't know. But that optionality and kind of people really having faith in Elon Musk coming through is what keeps the stock and its potential so high. But I will say that based on business results, this is definitely an expensive stock today, which is why it comes in at number 17. Coming in at number 16 is Robinhood, one of the most popular stocks right now. Now look, of course, it's not super hard to change your brokerage, but It does. It is kind of a pain. The more products that are layered in, the higher the switching costs become. And it's undeniable that this company has brand value with the people who we will be the biggest and perhaps wealthiest investors by 2036. They're also layering in other products like a platinum card, and they could benefit from agentic trading. That said, I do think the stock is expensive today, and we could see this company somehow be leapfrogged or competed into not oblivion, but less significance, which is why it is in this third bucket. Coming in at number 15 is Palantir. This company has shown that it definitely has switching costs when you sign 5 to 10 year agreements to deploy this technology in both governments and commercial entities, and you've got the buzz that this company's brand does. That's really important. And the optionality just comes from momentum, not stock momentum, but business momentum of expanding who you serve, especially in the commercial industry and especially using those forward deployed engineers. I think that the valuation today is slightly expensive. The downside risks do come from companies like Anthropic perhaps being able to do what Palantir does. I know they can't today, but that potential might be there in the future, which is why it lands in this bucket as well. Coming in at number 14 and the highest rated of this group, because I think it has the best chance of coming up on the top side, is Shopify. Look, once a merchant sets up their online presence on using Shopify, they don't want to focus on that part of the business. They want to focus on what they provide people. And the switching costs are really high, and the brand is really high here. The optionality, I think, comes from expanding their footprint more, but also agentic shopping, where Shopify teamed up with Google to really write the rules of how agentic shopping is going to work. And I think that the stock is fairly valued at today's prices. So those are kind of our boom and bust stocks. Now this next tier, tier 2, that's the ho-hum stocks, where these companies are probably going to be less volatile. And what that means is they'll have less worry about downside collapse, but also fewer explosive rallies. And it's really going to kind of hug the indexes or the markets and how they do. So coming in at number 13, the lowest rated of these is Disney, because look, the company has had problems lately. They've got really strong IP, but is it fading? Is it generating outsized returns? We haven't seen that as much lately. And when you think about optionality, Disney Plus was something that they did, but what else is there? They've already got so much. It's really about optimizing that existing system. I will say that I think the stock is slightly undervalued depending on how you look at it today, but this lands at number 13. Coming in at number 12 is Coca-Cola. Look, I'm not going to argue about the company's moat. It's not that hard to create an alternative to Coca-Cola, but people have been trying it forever and they've been unable to displace Coca-Cola. And of course, it's much more than Coca-Cola. The moat here is wide and stable, but really when I say much more, the only way that they add to their product portfolio is through acquisition. I don't see them really doing much else than that. And this stock is expensive, in my opinion, and has been for a long time. Why? Because of that first part, the wide and stable moat. But that being said, this lands at number 12. Coming in at number 11 is Johnson & Johnson. Now, when we talk about the company's moat, it's worth pointing out that they jettisoned many of their consumer goods products like Band-Aids and Tylenol. What we're left with is a drug company and a medical device company. Those do have wide moats, especially through patents and switching costs, but that can be variable depending on several things, which brings us to optionality. That variability comes from FDA clearance for both biopharmaceutical and medical devices and uptake of both of those things. So there is optionality there. I do think that the stock is overvalued today. And one thing I should mention about all the stocks in this ho-hum basket is you've got to include the dividends and the effect that they have over the next 10 years in this market-hugging type of basket. Coming in at number 10 is Walmart. Now, look, there's no denying that this company has a moat. They are able to provide goods at a lower cost because of their buying power and pass that along to their customers than many other people. The optionality I'm a little bit more questionable about. They did a brilliant job of acquiring Jet.com to have a real e-commerce strategy that has resonated with consumers. But the real thing to just be aware of, this will matter especially over the next 2 to 3 years. Over 10 years, it should become less important, but this is a very, very highly valued company. because of that moat up above right now. Very similar to Walmart, coming in at number 9 is Costco. I think this economic moat is almost unassailable because they're able to sell products at razor thin margins and pass along all the savings to their customers and make almost no profit on it, relying instead on membership fees to do that. And oh, by the way, those membership fees, they've shown that they can jack them up over time and they aren't going to lose everybody. That is a moat. I also believe that they've got more optionality than Walmart does, not just because they can expand their footprints more, but because they can get into ancillary services like pharmacies and eye care and things like that. That said, much like Walmart, this is a very, very expensive stock right now. Coming in at number 8 in the ho-hum stocks is none other than Berkshire Hathaway. I know Warren Buffett's no longer the CEO. He's still involved. When we talk about the company's moat, you really can't talk about just one moat because there's so many different businesses in here. I mean, you've got insurance, you've got railroads, you've got so many different things. They're strong moats, but they're varied. Optionality is a little bit funny when it comes to Berkshire Hathaway because it's all about that enormous cash pile that they've got sitting around and the type of investments and acquisitions that they can do with that. That does lend them some optionality, some anti-fragility, and I believe it is fairly valued at today's prices. And coming in at the top of this ho-hum basket is none other than Apple. Look, I think Apple has a very wide ecosystem moat, whether through your iMacs, which I'm coming to on now, iPhones, iPads, iServices, what have you, the App Store. It's a very wide ecosystem. I am less sure of what kind of optionality they might have moving forward. It might be the same things that I just said. Maybe they make a push into health. Maybe at some point in time they get some traction with AI, although it's largely been disappointing so far. But I think it's fairly valued and you cannot sleep on the value of this moat. And, perhaps them not spending so much on capital expenditures for AI and being able to return that to shareholders. So this is the ho-hum basket. Now we get to the most exciting one, which is the safest stocks, the highest probability of outperformance. Again, you aren't going to get your best performers out of all 25 in this basket, but if taken together, I believe you'll have the largest percentage of them that outperform the market. So what are these stocks? Well, before I get to that, I want to say that if you've enjoyed this type of content, you are a perfect candidate to join my program, Stock Investing Mentor. It comes in 3 parts. Part number 1 is that you get real-time access to my portfolio and all the moves I make with video explanations in real time. And not only that, but I have a database that I keep updated of all the stocks that I own and that are on my watch list. And I rate them on their moat strength, on their optionality, their financial fortitude, their management, and I give it an anti-fragile score, a valuation score, and this is regularly updated, as well as every 5 weeks picking out my top 5 stocks that I would invest in from this universe if I were starting a new portfolio today. And finally, you get 1 hour of live weekly training that is recorded if you can't make it on Thursdays at noon Eastern, and 24/7 access to a private online investing community. Now, if this interests you, click the top link in the show notes below and you can join Stock Investing Mentor for 10% off. All right, let's talk about this top tier. There's 6 stocks in it, starting off with number 6, which is Netflix. Now, I think Netflix has a wider moat than most people give them credit for. They raised prices, they cracked down on password sharing, they didn't lose people. There are switching costs. There's definite IP there. There are network effects because the more subscribers they have, the cheaper they can make new content per subscriber than anyone else in the world. I also think that there's optionality. They're testing out new formats. They brought us NFL games, NBA games, the sports, games, and geographic expansion. And I think that today the stock is fairly valued. So Netflix comes in at number 6. Coming in at number 5 is Microsoft. Look, the data gravity around all the things that enterprises keep on their platform with Microsoft is huge, and those are huge switching costs. And there's Azure, their cloud property. Now, I know that things have been frustrating recently for Microsoft with their AI strategy, but over the next 10 years, I believe they are building the infrastructure for agentic AI. And I think that the valuation is compelling today. So they come in at number 5. Coming in at number 4 is NVIDIA. Now, why NVIDIA up here and AMD? Well, part of it is because CUDA has such wide adoption. That's the software that's used to write programs using NVIDIA's chips that many are trained on throughout the tech world. And there's just the IP that this company has of being the first mover in this incredibly important industry right now. They are now at the point where they have yearly upgrades, see incredible uptake for those upgrades, and they're moving into other areas like CPUs and robotics. And I believe that the stock is quite undervalued today. So you combine those things, NVIDIA comes in at number 4. Coming in at number 3 is Amazon. Amazon is incredibly wide moat business, low cost production for package delivery, switching costs for AWS and Prime, network effects for the e-commerce business, and there's lots of optionality left. Advertising is doing very well. The company makes its own custom chips, and Project Leo, which was Kuiper for satellite connectivity, is optionality. And I think that it is fairly to slightly undervalued at today's prices. Coming in at number 2 is Alphabet, aka Google. Company that many people, myself included, were worried about just a couple of years ago. But I think the network effect is real in terms of gathering data to train AI as best you can, the low cost advantage of getting that data at a low internal cost and selling it to advertisers, the brand value, and they've got optionality left. Google Cloud has been doing very well. Waymo, still not really contributing needle-moving revenue, but really has the potential to. And their TPU chips are doing very well as well. And I think that the valuation is, it's slightly undervalued today. So Google, aka Alphabet, comes in at number 2. And of the 25 most popular stocks on the market today, if I had to choose one that I think is the safest bet to outperform the market over the next 10 years, it would be Meta Platforms. Look, there's no denying the company has a moat. It is the original social network across WhatsApp, Instagram, and Facebook. There's tons of network effects, also low-cost production of data. The problem is that the company has been spending hand over fist on capital expenditures for AI, and investors have rightly been worried about that. Why? Because they don't have an AWS, an Azure, a GCP. They're using this internally to improve monetization, which is working, and an AI assistant that they think that their users might start to adopt for their glasses or in the network. And there's a lot of people saying, well, Zuck went and did this very same thing with the metaverse, and we know how that turned out. That's true. But these are not necessarily sunk costs. They can turn that off and just focus on maximizing their free cash flow tomorrow if they wanted to. But even more importantly, they have compute. And if they decide to abandon this, that compute is still very valuable. Not to mention the fact that they just launched a project for subscriptions across their social media networks. And I believe the stock is very undervalued today. I think it's assuming